Greetings. This is Trading Lesson 17 for forex traders, stock traders, cryptocurrency traders, option traders, and the likes. Delivered by Atuegbe Izugi. You can contact me on +23 80 375 97085. Advice to like, share, subscribe, and refer others to this broadcast. When each breakout is smaller than the previous one, the trend's momentum is waning, and the deeper pullback or reversal might soon follow. Everyone looks at price charts, but usually just briefly and with a specific or limited goal. However, every chart has an incredible amount of information that can be used to make profitable trades, but much of it can be used effectively only if traders spend time to carefully understand what each bar on the chart is telling them about what institutional money is doing. Until a decade or so ago, most of the trade decisions were made, and most trading was done by very smart traders. But it is now increasingly being done by computers. They have programs that can instantly analyze economic data and immediately place trades based on that analysis without a person ever being involved in the trade. In addition, other firms trade huge volumes by using computer programs that place trades based on the statistical analysis of price action. Computer-generated trading now accounts for as much as 70% of the day's volume. Computers are very good at making decisions and placing chairs and winning at Jeopardy, and are more difficult than trading stocks. It is only a matter of time before computers are widely accepted as the best decision makers for institutional trading. The most important message that I can deliver is to focus on the best trades. Avoid the absolute worst setups. Use a profit objective that is at least as large as your protective stop, and work on increasing the number of shares that you are trading. Just as I can reverse my opinion about the direction of the market in an instant, I can also reverse my opinion about why a particular pattern works. If I come across a reason that is more logical, or if I discover a flaw in my logic. A trader has to walk through most obstacles before becoming consistently profitable. Usually in trading, those who know don't talk, and those who talk don't know. I believe that there is something to be learned from every tick that takes place during the day, and that there are far more great trades on every chart than just the few obvious ones. But to see them, you have to understand price action, and you cannot dismiss any bars as unimportant. I learned from performing thousands of operations through a microscope that some of the most important things can be very small. Indicators work well for many traders, but the best success comes once a trader finds an approach that is compatible with his or her personality. Oscillators tend to make traders look for reversals, focus less on price charts. These can be effective tools on most days when the market has 2 or 3 reversals lasting an hour or more. The problem comes when the market is trending strongly. If you focus too much on your indicators, we see that they are forming divergences all day long, and you might find yourself repeatedly entering counter trends and losing money. At the time you come to accept that the market is trending, you will not have enough time left in the day to recoup your losses. Instead, if you were simply looking at a bar or candle chart, you will see that market is clearly trending, and you will not be tempted by indicators to look for trend reversals. The most common successful reversal first break a trend line with strong momentum and then pull back to test the extreme. And if traders focus too much on divergences, they will often overlook these fundamental facts. Placing a trade because of a divergence in the absence of a prior counter-trend momentum surge that breaks a trend line is a losing strategy. Wait for the trend line break and then see if the test of the old extreme reverses or if the old trend resumes. You do not need an indicator to tell you that a strong reversal here is a high probability trade, at least for a scalp. There will almost certainly be a divergence, so why complicate your thinking by adding indicators to your calculus? I sleepily cannot process multiple indicators and time frame well in the time needed to place my orders accurately, and I find that carefully reading a single chart is far more profitable for me. Also, if I rely on indicators, I find that I get lazy in my price action reading and often miss the obvious price action. Price action is far more important than any other information, and if you sacrifice some of what it is telling you to gain information from something else, you are likely making a bad decision.